Shepherdson at Pantheon. I can see we've got a lot of people still joining the webinar, so we'll just wait for another minute or so. It's just after the hour now. Just wait for another minute or so, get everybody in, and then we'll get started. Thanks for your patience. We'll get started. I've got quite a lot of ground to cover, and I see there's still some people joining, but let's get started now. So, as you can see, I've called the webinar Brace for Slow Growth, Absent a Trade Fix, and I don't think there's going to be a trade fix. And also look out for tariff pass-through to inflation, which I guess is going to be the second story. But the first story that I think I want to emphasize is the growth picture, because there's a lot of talk, a lot of noise swirling around. The R word is being bandied around a bit. Just to be clear, I don't think there's going to be a recession, certainly not a recession that you would recognize from previous cyclical episodes. But I do think that grinding slow growth for the foreseeable future is quite likely. And against that sort of background, it's always possible to have a little accident and you could end up with a 0 or a negative quarter. But I don't expect to see a run of falling GDP numbers. And the big reason for that is that the private sector economy, in terms of the flows anyway, and in terms of the interest rate pressure on the private sector, is really in pretty good shape. So this first chart here shows the major financial balances in the private sector and the government sector. You can see the private sector, which is firms and households, running surplus about 5% of GDP. Look back, contrast that to what we saw, before the crash of 2008 and just before the recession in 2001, where the private sector was running quite big deficits. And so when the Fed raised rates, those deficits became painful to service. Companies cut back on hiring, people cut back on spending, recession. The story in 1990 was a bit different. Private sector was running surpluses, but the Fed went to 9.75%. And so real rates are excruciatingly high. So the broad rule is that in order to have a recession in the US, you need to have the private sector either very overstretched and the Fed quite tight, or merely the Fed extremely tight. Neither of these things apply now. The Fed's anything but tight. Real rates are below 0 again and heading lower in all likelihood. And the private sector is running surpluses, so both households and corporations are saving more than they're investing. The big deficit, of course, is in the government sector, but we're not talking about an emerging market here, so there's not a market mechanism that's going to quickly force the government into changing its behavior. Some of us might wish that there were, but there just isn't. So if there's going to be a recession in the US, it's going to be a private sector phenomenon, and at the moment, I don't see that. Of course, what this chart doesn't tell you is how the corporate and the household sectors respond to extreme uncertainty and to trade wars, because we've never had one before in the modern post-war era. And so that's where the risk is, that we see something that isn't something that happens that we can't see from the macro data. But again, just to emphasize how comfortable the private sector is at the moment, if we look at debt service costs, you can see debt service ratios for the corporate sector are extremely low. They're not as low as they were in 04, 05 because the stock of debt is much bigger. But you'll see that the increase in debt service ratios when the Fed was raising rates was trivial compared to what we saw in the previous cycle, when the rise in debt service ratios just followed exactly along behind from the Fed. That didn't happen this time, even though there's much more debt, because the debt's much longer. Everybody in the corporate sector did what the Fed wanted them to do, which was to take much longer debt. So by lengthening the debt, the business sector has made itself less vulnerable to the Fed. And of course, the Fed didn't raise rates as far anyway, and now it's easing. A different story in the household sector, but here the debt service ratio is rock bottom. This is the whole history of the Fed's official data on household debt service ratios. You can see it got very high in the middle of the last decade at the peak of the housing boom, but we've had substantial deleveraging in the household sector. Plus, again, everyone's refied into much cheaper mortgages. So in the household sector, no increase in debt service ratios as the Fed raised rates. The household sector is really very solidly protected from monetary policy, and isn't under any pressure. And Fed Vice Chair Clarida made this point in the Q&A last week that there's no reason to think that the private sector is under any sort of great pressure, except from things which have got nothing very much to do with the Fed. So here we have the chart that kind of captures the whole miserable story at the moment. The green line is the ISM manufacturing index for the US, and the blue and black lines are China's PMIs, official and unofficial, and they're advanced by 2 or 3 months. In other words, most of the time, if you want to know what's happening to US manufacturing, you just need to look at China 2 or 3 months ago. And that worked through 2017, through the boom. It worked through 2018 as China was slowing on the back of their excessive tightening. And it worked really until the spring of this year. Things started to go wrong in the spring of this year for a very specific reason, which is that the trade war blew up at the end of April. Remember Steve Mnuchin's final lapse of the trade talks? Yeah, well, he fell before the end and ended up in a heap. And immediately after that, the ISM broke to the downside relative to China's numbers, which were stabilizing. Now, the Caixin number has shot up in the last couple of months. I'm not sure that's sustainable, but it certainly is the case that it's not falling anymore. And the official number, which tends to be more stable, tends to have a bigger firms in the sample than the Caixin. That's stabilized as well. But the US numbers continue to go down. I don't think it'll go down much further, fingers crossed. But this is a pretty terrible picture. It's not at recession levels for the whole economy, but it certainly is for manufacturing. And this really is the trade war in a nutshell. Remember what happened after those talks broke down in late April, early May, was that within a couple of weeks, the tariff rate on capital goods and intermediate goods was increased from 10% to 25%. The 10% seems to have been absorbable by businesses because everybody on the supply chain took a bit of a hit, all the way from the Chinese manufacturers and exporters to the US wholesalers and importers, plus the RMB weakened as well. And so for each bit of the chain, it was kind of manageable. But jumping more or less overnight from 10 to 25% seems not to have been manageable. That seems to have caused great distress in the business sector. And most of the surveys have weakened substantially. And it's very striking if you compare the movement in the business surveys in recent months, the regional surveys, compare it to the regional share of Chinese exports in GDP, you get quite a nice picture where the bigger is the share of Chinese exports in regional GDP, the weaker has been the survey. The Philly Fed is the gigantic outlier. I don't know what they're smoking at Philly, but it'd be nice if everybody had some. The Philly region is a low export sensitive, low China export sensitive region, but it still seems to be massively outperforming. I don't really know why that is. But broadly speaking, the more exposed you are to the Chinese export business, the weaker your regional economy has been. And putting it all together, the national ISM, is pretty much on the trend line. So, like I said, I'm hoping this won't get a lot worse because the tariff position has now stabilized. Remember, on October 15th, that 25% tariff rate on capital and intermediate goods was supposed to rise to 30, but after the powwow in Washington with the Chinese a couple of weeks ago, that was abandoned, at least for now. So the tariff rate is stuck at 25%. The new tariff is, of course, on consumer goods. The first tranche was applied at 15% on September the 1st, and the next tranche is due on December the 15th. Whether that will be applied, I just don't know. But what we have at the moment is all capital and intermediate goods tariffed at 25%, and about half of consumer goods tariffed at 15%. This is a really big tax increase for consumers and businesses, and it's also, perhaps more importantly, a really big generator of extreme uncertainty for businesses and for households as well. So the response has been pretty clear. ISM production index and manufacturing output, the hard data, weakened substantially. Yes, I know that the hard data in the last couple of months have been a little bit better than the survey, but look at the noise on the chart. That's not unusual. You certainly can't look at those data and say that the manufacturing sector is magically outperforming on some sort of trend basis. A few more months of better numbers would say that, but we're just not at that point yet. And I think it would be wise to assume that some more of the downshift is still to come. If you look at it in terms of the GDP components, in terms of capex, again, a little bit better the hard data than the soft data in the last few months, but also deviations between these numbers are not unusual, and core capital good orders, I think, are likely still to be on a downward track. And by the way, those manufacturing output data, the previous chart there, that's excluding the effects of the GM strike. There's no autos in there. The GM strike is going to make a big difference to production in October as well, because the strike isn't over yet. Anyway, so that's the capex story for the ISM, which is mostly a large company survey. Looking at the NFIB, which is a small company survey, a pretty horrible picture there as well. The NFIB tends to lead by a couple of quarters. So I've just assumed that if the level of the index stays where it was in September, we've got 2 or 3 quarters of pretty grim capex data to come, and then a bit of a rebound, but not getting back to where we were. And that's assuming no further decline. And I think no further decline is kind of my theme for these industrial surveys. I think they're probably bottomed out now. That is contingent, to be clear, on China's numbers not taking another leg down. But the stabilization of the Caixin and the official PMIs in China looks pretty solid to me now. And we're seeing the beginnings of an upturn in Chinese money supply growth, which is an absolutely key leading indicator. It's weaker than we hoped for. It's taken longer than we hoped for. And it's indicating that China doesn't get the bang for the buck that it used to get with monetary policy stimulus. But nonetheless, the basic principle is fair, that the money supply numbers lead, the PMIs lead, and they're not getting worse. So fingers crossed, the manufacturing picture in the US won't get worse either in the soft data, but the hard numbers have to catch up. That's the problem, really. I'm also very worried about the export picture, which is just horrendous. So I'm going to attempt to draw a straight line. I'm going to fail, but here goes. So this is that's the ISM export orders index at the bottom of the cycle in 08, and there we are now, and not a million miles away from it. And that's the horrendous outlook for exporters. It suggests that U.S. export demand has just cratered over the last few months. A minus 15% reading. This is real exports of goods and services. This is the GDP component. If that falls by 15%, you're looking at a 1.7 percentage point hit to GDP growth in the fourth quarter. 1.7 percentage points. Now, bear in mind that I think the trend in GDP growth right now is about 1.7 percentage points. This is how you end up with an accidental drop in GDP. Weak capital spending, as per the previous chart, and then a hit in exports. The good news is that the survey isn't always a reliable indicator of the actual export numbers, but the bad news is that over the last couple of years, the hard data, in this case, have tended to be weaker than the survey. So it's really quite easy to lose a lot of sleep over the potential for exports to absolutely crater in Q4, and I'm watching these numbers really very closely. On the inventory side of the GDP numbers, remember, thinking about the corporate sector and how it impacts GDP, it's capex, it's exports, and it's inventories. The inventory cycle is pretty straightforward. Yeah, the monthly numbers are all over the place, but the trend, it just lags business sales. Businesses don't seem to forecast very aggressively. They just, sorry, excuse me. Okay, sorry, I thought we had a technical problem there. The inventory numbers tend to lag the sales numbers by a few months. Businesses don't seem to make an aggressive forecast of the future that's any different from what they saw last week. Anyway, what they saw last week has been clearly slower sales growth. So the message there is that the inventory picture is going to drag on growth as well. So now Q4, Q1, falling exports, falling capex, falling inventories. This is a pretty messy picture, and all the corporate contributions to growth are likely to be weak or in some cases very substantially negative. So there's an offset, and the offset is the consumer, in the sense that the consumer's real income picture is still quite favorable. It's slowing. Now, remember, last year, consumers' real income growth was very strong, and it picked up because of the tax cuts. The tax cuts just put money into people's pockets at the start of the year. So there had to be a slowdown this year. There just had to be. And so far, it's just taken us back to where we were before the tax cuts kicked in. The problem is that one of the big components of this is payroll growth. And payroll growth has slowed substantially, and I think it's going to slow further. And that's going to be a drag on income growth going forward. Plus, of course, the risk of inflation pass-through from the tariffs on consumer goods. So two of the components of real income growth are likely to be under pressure. The third, of course, is wage growth, which I'll come back to. That's a positive, but wage growth per hour anyway, per worker. But payroll growth and higher inflation, that's a tricky combination. You can see that over the last couple of years, spending growth has run a little bit below income growth. In other words, the saving rate has gone up. I don't know whether that's going to continue. Normally, the saving rate goes up when the Fed's raising rates, which until recently they were. But if real income growth is going to slow substantially towards the 2% mark, I think it would be wise to assume that consumption growth will slow as well. It's going to remain positive. There is no reason to expect a rollover from the consumer, but I don't think it's going to get any better. If you look at the confidence numbers, the Michigan expectations number, again, it's over-predicted spending. This is retail control sales. It's over-predicted spending for the last few years. They're kind of in line now, but broadly speaking, it's hard to see any upward momentum here. And if we're going to see substantially slower payroll growth, it would be reasonable to think there might be some downward momentum to emerge in those sales numbers. Right now, well, certainly until very recently, I think sales have been boosted perversely by the trade war because of the threat of tariffs on consumer goods triggered an uptick in chain store sales. So here's the Red Book, the weekly numbers. You can see very clear upturn in the weeks after the tariffs were announced, and then a reversal in the past few weeks. And we were on a sort of downward trend before the tariff announcement, and back on it. So a couple of months of activity, but all that happened was that August and September probably stole spending that otherwise would have happened in October, November. So again, the outlook for the fourth quarter is deteriorating, even though the recent picture has been fine. This is not disastrous, to be clear. Chain store sales growth of 3 or 4% is not disastrous. It's going back to where it was before the trade war. But if you've been relying on consumers charging along and offsetting any weakness from the corporate sector, I think that story is going to come under a degree of stress as the labour market continues to weaken. So let's have a look at the labour market. Before we go, that's car sales, which are trending kind of flat. So again, very volatile. But nonetheless, it's hard to see any momentum there. This, I think, is a story for the consumer. It's an absence of momentum at this point, rather than the presence of any sort of aggressive downshift. But the danger is that if the labour market weakens substantially, we could move into that rather more disconcerting picture fairly shortly. The one bright spot, I don't want to be unremittingly gloomy, but the one bright spot before we move on to the labour market is the housing market, where I'm really quite bullish. So what we've got here is the mortgage purchase applications index. The headline number includes refis, so ignore that. Unfortunately, you probably need to ignore the purchase index as well, because the seasonal adjustment is beyond nonsense. So what I've done on this chart here, the blue line is the MBA's purchase applications index, but I've readjusted it because their seasonals are hopeless. Anyway, once it's readjusted, it's a pretty good leading indicator of home sales. As you can see, the housing market massively underperformed last year. That was in the early part of the year. That was because of the changes to the tax rules, the capping of state and local tax deductions. And then at the very end of the year, Hurricane Florence, Hurricane Michael, they hammered the market for a while. But the market has now adjusted to the changes in the tax rules, and the hurricane effect is gone. And so sales are pretty much back to where they should be. In the next few months, I'm expecting total home sales, new and existing, to hit new cycle highs. That's why we're starting to see a clear upswing. Oh, actually, it's not just starting, it's very much underway now, a clear upswing in home builders' confidence. And that's going to be reflected in stronger housing construction in Q4 and Q1. We could easily see double-digit growth in housing construction over the next couple of quarters, which is great. I'm very happy about it, but it's 3.7% of GDP. It's the other 96% plus that I'm worried about. So I think it's perfectly reasonable and consistent to be bullish on housing, but to be really rather less bullish on the rest of the economy. So let's have a look at the labour market. So first of all, state the blindingly obvious, payroll growth has slowed substantially. Again, rather like those income numbers, it picked up in 2018 because of the tax cuts, and it had to mean revert, but it's done more than mean revert. That's the problem. We're now into a picture where we haven't been in this cycle. And this is all because business hiring plans have been cut back. There's been no pickup in jobless claims. I would expect no pickup in jobless claims. In the early part of a downturn, the first things companies do when demand wobbles, they don't start firing people, they cut back on the hiring. That's quick and immediate, and it's cheap, and hiring is disruptive and it's expensive. Sorry, firing. Disruptive, expensive, it's time consuming. And of course, if you fire people and then demand revives, well, how are you going to hire them back when unemployment's 3.5%? They're probably gone. So all the adjustment has been on the hiring side, and it's been quite dramatic, and it's probably going to get worse. So the blue line is a bunch of hiring indicators that I've just crunched into a single index, and the black line is the initial estimate for private sector payrolls every month. And yeah, I mean, the message is very clear. Pickup in 2017-18, sustained strength in 2018, clear, unambiguous downshift. And we're now looking at payroll growth of about 50,000 a month by the end of the year. Now, can't promise anything, but the hiring indicator has been pretty reliable over the last few years, and the message there is consistent with this theme of uncertainty and the taxation effect, the dampening effect of the tariffs. Payroll growth of 50,000, is not recession level. That would be negative, but it's certainly a very substantial hit. To be losing, 150,000 jobs a month relative to where you were just, 6-9 months ago, is really quite a big hit. It's more than 1% of household incomes is being lost through that slowdown in payroll growth. Also, labor force growth is a lot more than 50,000. It's very volatile, but the trend is around 125,000 per month. So if payroll growth settles down at 50, just assuming those hiring indicators don't get any worse, and the labor force continues to grow at 125 a month, then this is what happens to the unemployment rate. It doesn't shoot up. It doesn't even go above 4% by the end of next year, but it clearly moves. It changes, and that long downward trend since 2010, when it peaked at 10%, that begins to reverse. And that's going to be very difficult from a sort of a political management perspective, because of course the falling unemployment rate and the great payroll numbers have been the one unambiguous positive point in the macro data recently. So that's changing. What I think it doesn't do quickly is to change the wage story. The payroll numbers and this initial uptick in unemployment that I'm expecting are a flow story rather than a stock story. The stock story is that the unemployment rate remains extremely low even at the end of that forecast period, and the labour market remains very tight. So I don't think this immediately starts to push wage growth down. So there's 100 different indicators of wage growth. This is the NFIB survey. The proportion of NFIB members that are citing labour costs as their main problem. It tends to lead by about a year. Yes, there was a clear undershoot in wage growth in September, but that looks like noise, not signal. We get these occasional weird months. There's nothing that we haven't seen before. The point here, I think, is that the trend is still moving to the upside, and certainly the survey evidence is moving to the upside. And it would take more than a very small increase in the unemployment rate to make a meaningful difference to that picture. Looking at it from the employee side of the equation as well, I think is also interesting, because what we're seeing now is a real increase in strike activity. People in the labour force finally pushing for bigger raises. Obviously, GM's on strike now. Chicago teachers are on strike. These are big numbers and very highly public strikes in the unionized economy. So you can see that we've just gone above, fairly recently anyway, just gone slightly above the peak in 2006 in terms of strike days. And as you can see, strike days used to lead wage growth quite closely. Now they lead it more loosely, but nonetheless, the big picture is the same for both. But what's interesting here is that it's taken 10 years to get back to that strike peak from the end of the recession in 2009. Whereas in the last cycle, it took 5 years. The recession ended in November 2001, and the strike peak was in the fall of 2006. So 5 years compared to 10 years. And I'm guessing that this is because people were much more traumatized by the experience of the crash in '08 than they were by the regular sort of garden variety recession of 2001. And for a very long time afterwards, people were just happy to have a job. And so they kept their heads down and they didn't push for a bigger raise. And now they want some. Now the GM strike is very explicit. The GM union's position is, look, we gave up a lot at the time of the rescue in 2008, and now the company is profitable, and we want to get paid. It's essentially the same argument that the British Airways pilots are making as well. So this is not just confined to the US. I think that the GM people are probably going to win. The details of the settlement aren't public yet, and actually they haven't agreed it. But I think they'll probably win. Most of the teachers' unions that have been on strike in the last couple of years have won. The hotel workers on the West Coast won. The supermarket workers in the Northeast at Stop and Shop, they won. The Verizon guys won. I think it's quite likely that Chicago teachers will win as well. And bearing in mind that they've turned down 3% a year pay increase every year for the next 5 years, whatever they settle at is very likely to be above the prevailing rate of hourly wage growth. So this to me suggests that the labour market isn't going to loosen overnight. And is probably more likely to tighten in terms of wage growth than to loosen. And of course, that makes things difficult potentially for the Fed because faster wage growth pushes up some of the key components of core inflation, notably rents. So my rent model here, it's not a perfect track on a quarterly basis, but it's kind of captured that upward grinding upturn in rents for the last few years. It's just based off the vacancy rate, which is rock bottom 33-year low, and it's not going anywhere, and wage growth. And if wage growth picks up a bit, then rent inflation will pick up a bit as well, and that's 41% of the core CPI. But it also will pass through into some other elements of the CPI as well, and the vulnerable ones are things like healthcare, household services, education, which are very labour dependent. At the same time, of course, we have the risk of pass-through from tariffs on goods. And right now, goods inflation has risen over the last couple of years. Some of this is due to tariff pass-through. There are some tariffs already on some consumer goods. Children's furniture is tariffed, for example. Washing machines are tariffed. Car parts, motorcycles, sewing machines, various other teeny components have all been subject to tariffs for a while. So we've seen an upshift. The idea of falling goods prices forever, which was clearly justified by the data for a very long time, that's pretty much gone. And bearing in mind that this has happened at a time of a strong dollar, this indicates that the tariff story is actually potentially quite powerful. Now, at the moment, the new tariffs have only been applied to about half of consumer goods. The second half comes in December. But we're looking by the end of the year, potentially 8 or at the most maybe 10% of the core CPI being subject to tariffs. Now that's a lot. Those tariffs are 15%. So 15% tariffs on 10% of the core CPI, that's a big uplift. Now, I'm not saying that will all come through, but I think it'd be very dangerous to assume that none of it will come through. And that's important because if you look at the Fed's forecast, that's what they seem to be assuming. Right now, the Fed in September, the core PCE forecast from the Fed is 1.9 year over year at the end of this year, and it's 1.9 at the end of next year. In other words, no visible tariff pass-through. Now, you could say they justified that by cutting their growth forecast and raising their unemployment forecast, so more slack in the economy, inflation doesn't get passed through, except they didn't change their unemployment forecast or their growth forecast at all between June and September. It seems to me that the Fed is potentially setting itself up to fail and actually have an inflation overshoot for the first time in a very long time, because if you look at the behavior of some of those components that have been tariffed, it came through. Here's laundry equipment, washing machines. So the year-over-year rate went from -5 to +16 pretty much overnight. Okay, it's back down to where it was before the tariff started, but nonetheless, that was a one-year substantial burst. It all got passed through immediately. 20% tariff, so -5 to +15. Yeah, it all got passed through. Will this happen with a broad range of consumer goods? I just don't know, but I'm pretty sure that it's going to be extremely difficult to find a 15% margin squeeze on a lot of small ticket consumer goods. The margins in these businesses are very fine to begin with. I just can't see where you might find, I don't know, $15 on a $100 pair of sneakers. Where is that margin compression going to come from? I just don't see it. So I'm really quite concerned that we're going to see quite a lot of pass-through at a time when wage growth is picking up. the initial response of the Fed to this is going to be to say, well, it'll drop out after a year, as it did with washing machines. But that argument will be much more difficult to make if wage growth is picking up. So it's not just the timing and the size of the tariff impact you need to think about. It's also the impact of the of wages and the danger for second round effects. Oh, by the way, I should have said earlier, please feel free if you want to ask any questions, just to hit the chat button and type away, and then I can come back to them at the end. This is extremely uncertain. I think anyone who bangs the table here and says that they know what's going to happen with tariff pass-through is killing themselves, because we just don't know. We don't really have any modern experience of this on a big scale. Yeah, we've got a few specific items, but we don't have this sort of broad tariff thing. We certainly haven't had tariffs applied to small ticket consumer goods in any meaningful way, and we just don't know how businesses will respond. But I think it would be very unwise to assume that there won't be any pass-through. Bear in mind as well that there is a very adverse base effect in the core CPI and the core PCE starting in the first quarter of next year, starting in January, actually. Remember, one of the things that made it so easy for the Fed to cut rates at the start of this year, to think about cutting rates at the start of this year and then actually doing it later on, what made it easy for them was that core PCE inflation cratered in the first quarter. The core PCE has about 360 components, and 3 of them fell sharply: financial services, used cars, and clothing. I think it's unlikely that any of those 3 things repeat their movements in the first quarter of next year. So the year-over-year rate's going to rise back to 2% anyway, which is where it was before the Q1 downshift. And that's before you add in any tariff impact. So it seems, I think, very easy to imagine that by the spring, the core PCE rate will be running at 2.2, 2.3, maybe even 2.4, and yet the Fed has it flat at 1.9 all year. So if they're looking for reasons not to be cutting rates next spring and summer in the run-up to the election, when I think they pretty much prefer not to be doing anything, then being able to say that inflation is overshooting your forecast is really pretty helpful. What's helpful to you as the Fed is not necessarily helpful to the markets, if at the same time the story is all about margin compression and slower sales growth, and why isn't the Fed rescuing us to the extent that we thought that they would. So this is kind of my worry for next year, is that we get, I'm going to use the S word, stagflation, but just to emphasize on a very small scale, nothing that you would recognize as being stagflation from the 70s or the early 80s, but just the principle of growth being slower than everybody would like, and inflation being a little bit higher, and acting as a constraint on the Fed. I'm pretty sure they're going to ease next week, and wouldn't surprise me at all if they eased again early next year. But I think after that, it might well become a bit more difficult for them. I think there may well be a constraint on them that markets at the moment don't want to see. Markets are very heavily invested in, well, it's a faith really that the Fed will just keep cutting rates when growth slows indefinitely, and I'm not sure that'll be the case if this inflation pickup does materialize. Now, one way of looking for it is to look at the NFIB survey, because it asks companies across the whole economy, what are you doing to your selling prices? And it's not a perfect indicator, but it tends to lead the core CPI by almost a year, and it's suggesting a little bit of net upward pressure. But of course, we haven't yet seen how they're going to respond to the tariffs coming through. The tariffs were only effective on September 1st, so the stuff is just getting through customs and into the port, out of the ports now and into the supply chain. So I'm very curious to see what that number does over the next few months. If it rises sharply, that would be a clear indication that businesses are planning, or hoping anyway, to pass on the increase. So this is a very uncertain environment, and there's a lot of questions that about the extent of tariff pass-through and the Fed's response that we just can't answer, because we don't know. We're kind of in a Donald Rumsfeld world of unknown unknowns at this point, because the page, where you look at the history books of the recent history of how did the US respond to tariffs, the page is completely blank. We just don't know. We don't know what the reaction function is of businesses or individuals, or the Fed really at this point, because they've cut rates. That's because the inflation numbers have let them, and the inflation numbers may be about to change. What I am more confident of is the sort of grinding slowdown story. I can't be sure that the US won't tip into any sort of recession, but I'm hopeful that it'll be avoidable. And if we get a negative number for GDP in the fourth quarter, my base case now is that it would not be followed by another negative number in the first quarter. But nonetheless, printing any negative GDP number is going to really put the cat among the pigeons politically. You'll notice that I haven't said anything about politics. I'm going to keep it that way. I've just got no idea what's going to happen. Everybody can read the polling, but what's actually going to happen there, I think in the short term, doesn't really impinge on the macro story. unless it impinges on the trade story. And on the trade story, where I do have a view, I think that it's quite likely that at some point next year, maybe in the late winter or the early spring, that the US blinks, that Trump blinks, because the trade war is going to be hurting him unambiguously. And the rational thing to do is to take the tariffs off in the hope that the stock market rebounds, confidence rebounds, and it kind of gives you some sort of lift in the polls. Will that bring the Chinese back to the table? Probably. Will it bring them to an agreement with Trump? I think probably not, because I think they'd probably assume they'd get a better deal with whoever wins the election, assuming it isn't Trump. But I do think there's quite a good chance of a blink. And that's one of the reasons, again, for not thinking that this slowdown lasts indefinitely, because although a trade deal would be the best thing, removing the tariffs and calling it a leveling of the playing field, let's get these negotiations started, I can do a deal, never mind what I did before. That would be very positive for stocks. It'd be very positive for the confidence surveys, and it would probably lift hard activity as well. After a lag, whether it would be enough is a different question. What I am confident of is that getting to the end of let's say to the election next year with the tariff regime exactly as it is now is probably the least likely outcome, because the one thing we know about Trump, we can speculate about him all day, but the one thing we know for sure is that he's not passive. He doesn't sit back and let things happen to him. He wants to be on the front foot all the time. He's on the back foot on trade now, and I don't think that's sustainable. So my guess is that we will see a response. My guess is his response is going to come after some terrible macro numbers, which probably means first few months of next year. And that response, I hope, will be drastically to reduce or maybe even to remove the tariffs in the hope of getting China to the table. China can't negotiate with the tariff gun to their head, especially with what's going on in Hong Kong. They can't appear to be weak. Xi Jinping can't appear to be pushed around, because that just sends a green light to the people in Hong Kong to push him as well. But I do think there'll be a blink, and then hopefully that means that this macro grinding slowdown doesn't last forever. But we're in the realms of speculation at that point. What I think we have in our future, based on what we're seeing in the data today, never mind the potential for a future blink, what we have in the data today is a grinding slowdown and the risk of inflation. So just to wrap up, and then happy to take any questions. Growth is slowing right now. Third quarter growth, I'm at 1.5%. Forecasts are, some of them are as low as 1.25%. Some people are as high as 2%. But I think 1.5%, based on what we've got now, is reasonable, I think. And then Q4. Well, if exports are as weak as the survey suggests, then a negative zero or even a slightly negative GDP number is entirely likely. The chance of a quick rebound from a 1.5 in the fourth quarter, I think, is very low. I just can't see it. It's not in any of the soft data. So I think we have to assume that things get worse before they get better. And then just the point I was making earlier, a real rebound in growth, something that's sustainable, not until the trade war's over. The uncertainty is just deadly. And I don't see that going away until we get a comprehensive deal. And I don't see a comprehensive deal under Trump. If Trump was ahead in the polls, it would be a different story, because then China would need to do a deal with him. But they can read the same polls as everybody else. The latest polling out today shows all the major Democrat candidates on a head-to-head nationally beating Trump by between 6 and 10 points. So if I were China, I wouldn't want to do a deal with him. He's obsessed with reducing the trade deficit substantially, and that's something that China really can't offer. They can change their IP practices and their technology theft and all the rest of it, but the structures of these two economies are such that there's always going to be a big bilateral deficit, and however much Trump wants it to be waved away with a magic wand, there isn't a magic wand. So negotiating with a guy who wants something that you can't offer is quite difficult. I think the Chinese will probably just string him along and wait. Fed, again, I think they cut rates next week by 25 and maybe once more. But the key thing to watch here is the speed and the extent of this tariff pass-through in the goods numbers, in the core goods components, and the wage response. The nightmare scenario for the Fed next spring is slow growth and no prospect of any improvement. Inflation popping above the target because of tariff pass-through and maybe a bit of upward pressure on the labor market sensitive bits like rent, medical, and the tariffs pushing up core goods prices. That really is a very messy situation. And again, I'd stress the uncertainty here, but the market expectation that the Fed will just get everybody off the hook every time by cutting rates endlessly, that's really quite a risky assumption. So I think if I wrap up there, I think we've covered quite a lot of ground in quite a short time. So I don't know if there's any questions. I'm not seeing it at the moment, but if you have any, I'm happy to wait for a couple of minutes while you type away. So there's a couple of questions coming in now. So I'll keep these anonymous. I'll just read out the questions rather than the sender. Is the data in the soft data due to idiosyncratic factors other than trade, slowdown of oil capex, Boeing exports, higher taxes in high GDP states? There is definitely a bit of that. The Boeing export thing is clearly a problem, but Boeing orders have dropped basically to zero, more or less. The actual flow of exports hasn't changed very much because the production cycle is so long, but the export numbers are definitely weakening. There's no question that there's a hit there, but I can't believe that's the whole hit. Just to go back to this chart here, so Boeing's headquarters in Chicago. And you can see there, looking at the regional surveys and looking at the China export sensitivity, the Chicago PMI is the biggest underperformer relative to the trend line. It's the worst of the lot. And that's probably the Boeing effect in there. CapEx in the oil business is certainly weakening. New well drilling is slowing. There's no question about that. At this point, it's very small compared to what we saw in 2014-15 when oil capex dropped by more than 60% from peak to trough. But yeah, it's not helpful. The Fed now argues that the US is kind of neutral to oil prices in the sense that the capex drop when prices fall is kind of equal to the consumer gain from cheaper gasoline. I think actually in the short term, the US is actually slightly negative when oil prices fall. So I think that the drop in oil prices is a drag, but it's not the main event. The main event, I think, is still the trade war. Remember that this downside break, again, just go back to the chart of the ISM. This downside break, it came. This is April. This is a breakdown of the negotiations. That's the story primarily. Okay, the magnitude of the unemployment increase in the forecasts has always triggered recession in the last 50 years. Presumably some kind of tipping point, but not this time. Okay, so there's a lot of research now that says that when the unemployment rate rises for 3 or 4 months, it's always accompanied by recessions. And so that's a very useful metric in a normal business cycle, but this is not a normal business cycle. So it's not obvious to me that the normal rules apply. Like I said, I think we're going to come close to a recession. And 1/4 of GDP are only 3 months away. I think that just applying normal cyclical rules at this point is dangerous because, normally the US doesn't have a recession until real interest rates are substantially positive. To get one with real interest rates negative would be quite a thing. So I think this is not the core of the story, but certainly in terms of the optics, a rising unemployment rate is going to play very badly. And the danger of a feedback loop into consumer confidence and then into spending is very real. No question about that. Okay, explain the recent spike in repo rates, and does that have to do with pressures of high budget deficits? Yes, though it's primarily really in the medium term. It's just a question of the shrinkage of the Fed's balance sheet relative. The shrinkage of excess bank reserves correlates very nicely with the IOER Fed funds spread, and when Fed funds pressures build, then you get the spike in repo rates. So I think that what they've done, adding potentially 350, 400 billion net in bills over the next 6 months is of the right order of magnitude. I can send anybody the chart who wants to see it, just suggesting that would be the right order of magnitude to restore the previous relationship between rates and therefore to prevent repo spikes. But it's not going to go away unless there's a permanent addition to reserve. So it may well be that what they've promised to do over the next few months doesn't ultimately turn out to be enough. If funding pressures continue to rise. But certainly in terms of orders of magnitude, I think they've done roughly what I expected them to do. We'll see whether that proves to be enough as deficits continue to rise. What's estimates for PC in GDP in Q3 and Q4? So I've got consumer spending at 2.6, 2.7 in the third quarter, and I've got it at 2% in the fourth. Now, this question is ambiguous. It might be PCE deflator, in which case I've got that at 2% in the fourth quarter, and in the third, off the top of my head, I can't remember. Apart from progress on the trade front, is there a bull case you can make for major stock indices from here? Not really. No. I mean, I can make a case for saying that that the next lot of news coming out of European and Chinese manufacturing will be positive. So that will be helpful at the margin. European manufacturing's had a horrendous year, and so has China's. But money supply growth in both economies is picking up. And again, to emphasize, that doesn't work in the US. Money supply growth isn't a reliable indicator of anything. But in Europe and in China, which are much more bank-driven economies, money supply growth, liquidity growth is really hugely important. And in both places, it's beginning to turn up. So the news will remain terrible, but the delta will be favorable. The news will be less terrible, I think, over the next few months coming out of Europe. And actually, we are reasonably constructive on European equities. So some feedback from that into the US, I think, is a reasonable bet, but it does kind of run into this brick wall of the trade thing. So, I mean, I'm always going to be happier to see things improving elsewhere in the world, relative to where we are now when you're looking at US markets, but it doesn't provide a comprehensive fix. And of course, it's quite sector specific. I mean, the bulk of the US market is not exporting to China or exporting to Europe. It's selling things to domestic consumers. So yes, helpful at the margin for sure, but I'm not sure that that there's any real sort of game changers other than a trade deal. All right, give me your views for the next 3 to 6 months before trade resolution. What sort of downside do you see in US equities? Oh, this is impossible. Meaningful but not catastrophic, I think, is the way I would describe it. Valuations are high, but they're not insane. And I'm not looking for a recession. I'm looking for a slowdown. And I think most people are looking for a slowdown now anyway. I'm probably more bearish than most people on the potential for margin compression due to the tariffs and wage growth. I think I would say that. So, if you were to say to me that the S&P is going to drop 10%, between now and February, say, I'm probably not going to argue that the immediate response of yields to the equity market correcting like that is going to be to drop. Obviously, no question about that. What they do subsequently will depend on what happens to inflation, because ultimately inflation is what counts. For bond deals, it's all about inflation. Nobody doubts that they're going to receive their nominal dollar coupon. So what matters is the real value of that coupon, and the real value of that coupon depends on what happens to inflation. So I have higher inflation forecasts, I think, than the consensus. I mean, they're not massively higher, but they're certainly a bit above consensus and a bit above what the Fed thinks. And so the potential there, for inflation to surprise to the upside, I think puts a limit to how our yields can respond. And this is where things get messy. This is how you end up, with a situation where kind of the equity market's got nowhere to go because it's not getting the valuation support because the Fed can't cut rates as fast as people want, and there's margin compression. And that's a pretty unpleasant combination for stocks if it happens. I mean, if the Fed just abandon all thought of worrying about inflation and just keep cutting, then it's fine. But I'm not sure that that's going to be the case. So it really is a question of looking at this nexus, this combination of earnings growth, valuation risks, and inflation. And to me, it's kind of toxic on a 3 to 6 month view. Once Trump blinks, if he does blink, then it's different. If he blinks and substantially, and the tariffs are removed, then do you want to be short the S&P the morning when he tweets he's taking the tariffs off? Well, I think that question answers itself. So, it's potentially messy in the short term, but always with the danger of being blindsided by Trump doing the smart thing on tariffs. And finally, a question that I think we should wrap up. I've taken a lot of your time. A view on the dollar. Well, it's mixed. It depends where you look. I mean, cable, we're expecting a resolution of sorts anyway to the Brexit, I don't know what word to use, fiasco, chaos, insanity, whatever you want to call it. But certainly I think some clarity emerging. I mean, our base case now, for the record, is going to be an election and the Conservatives will win with a meaningful majority. If they do, then they'll be able to push Johnson's deal through, and then cable can rebound to 35, maybe even more than that. Euro, well, as I said earlier, we're a little bit positive on the euro at the moment. It's all very tentative at this point, but it's very hard to see a lot incremental downside for the euro. kind of expect it to be maybe a little bit stronger, but don't really have a massive view one way or the other at this point. We need to see whether this tentative upswing is going to become more sustained. And I guess we're kind of bearish on the yen because we don't really see any structural, meaningful structural change there. Structural improvement, I should say. Whereas, the US is not broken. I mean, and this is a really important point here that, when people are comparing the absence of inflation in Japan and the Eurozone to the US, I think it's important to think about more than just a snapshot of the current inflation rates. The PCE inflation in the US is very low, but before the weirdness of last year, it was 2% and it had been trending higher. I think if it hadn't been for the trade war, this is an interesting counterfactual. We could argue about it, but I mean, my view is that if we hadn't had the trade war, US growth would have remained at 2.5% or more. Payroll growth would have remained in the high hundreds. Unemployment rate by now would be 3%, and the Fed would be raising rates, and we'd all be looking around saying, hey, this looks like a recognizable end of a normal cycle. Okay, inflation's a little bit lower than it was back at the end of the last cycle, but it's not an order of magnitude lower because we're not Japan. We're not the Eurozone. We don't have the euro. We don't have Japan's enormous structural difficulties. We don't have the demographic problems of Europe or Japan. We don't have the banking problems of Europe and Japan. We're a recognizably normal late cycle economy, and if you'd been parachuted in from 2001, you would probably recognize it as such. It's just we didn't get the chance to see that because of the insanity of the trade war. And I'm hopeful that if the trade war were to end tomorrow, then the economy could get back onto that more positive story, and the scars will take some time to heal. And of course, the longer it goes on, the deeper the scars will be. But it's not unfixable, that's for sure. Of course, my take on this is that the rational thing for Trump to do would be to take the tariffs off today, but he hasn't done it yet. Last time I looked, it would have been rational for him to take them off yesterday, but he didn't do it then either. So, trying to sort of put a rational analysis overlay on what he might do isn't necessarily very productive, because we would never have got into this thing in the first place. He was badly advised. I think that Navarro and Lighthizer told him that the Chinese would fold. Well, they don't fold just like that. 18 months ago, they certainly didn't. And the chance of them folding right now, given what's going on in Hong Kong, I think is nil. So I think he's got himself into a position that he really can't get out of. But that's not the same as saying that the US is permanently broken, that it's Japanifying, or even that it's Eurozonifying. That's a new word. Because it's not, and my guess is that actually, had the trade war not happened, we'd be looking at a sort of more typical, recognizable late cycle economy. Yeah, the neutral real interest rate has fallen, but I think the trade war's made it look like it's fallen a lot further than it actually has. Anyway, right, I think that's the end of the questions I can see. So I'm just going to say thank you very much for your time. Much appreciated. There's been a lot of people on this webinar, so that's great. Please feel free to follow up with any questions, anything that you didn't ask, or anything you want clarification or more detail on. Very welcome to do that. Find me on email, inapantheonmacro.com or Bloomberg. And we can carry on the conversation. And in the immortal words of the president, I guess we'll see what happens. Thanks very much for your time.